So what actually is liquidity? Well, most traders will tell you it's how easy it is to buy or sell something, and technically they're not wrong. But that definition doesn't really help you trade. So here's one that does. Think of liquidity like fuel for the market. It basically can't move without it. Just like a car can't move without petrol or diesel or electric, I guess. Price can't move from one level to the next without a sufficient pool of orders to facilitate that movement. I'll explain what I mean by that on some charts in a second, but here's where most people get it wrong. Liquidity in these markets isn't just buyers and sellers. It's specifically resting stop orders sitting at predictable areas, waiting to be triggered. We call these areas liquidity pools, and not every liquidity pool is an equally weighted draw. Every retail trader has been taught the same things. Place your stops above old highs and below old lows, beyond trend lines and outside of consolidation ranges. And we've all read the same books, right? And watched the same videos, being taught by the same educators. And because of that, we've all been programmed to place our orders in the same places. Now, since the market is algorithmically coded, of course, it has one specific purpose: to engineer liquidity. It doesn't know where your stop is. It can't see your account. It has no idea you exist, but it doesn't need to, because it's been programmed to move price towards the areas where resting orders are most likely to be found. The same areas you've been taught to put your stop. And the institutions sitting behind the algorithm, the smart money, they need that liquidity because they're not trading your size. They're moving billions, right? And to move billions, they need a large pool of orders on the other side. So the algorithm engineers those conditions. It moves price to where stops are clustered, triggers them, and uses that flood of orders to facilitate institutional accumulation and distribution. Again, I'll explain what that means in a minute. Your stop loss isn't just protecting your trade. It's the liquidity the algorithm was coded to find. And once you understand that, every time you've been stopped out and watched price reverse and go exactly to where you thought it was going, you weren't just unlucky, you were literally the liquidity. My name's Ali Khan, and I've been trading liquidity concepts for almost 10 years now, and in this video, I'm going to break them down. Let's get into it. All right, so the first thing that we really need to understand is where liquidity resides inside of the marketplace, right? And in order to do that, we need to understand the 3-bar swing. So what's a 3-bar swing? Well, essentially, it's a pattern of 3 candles, where the middle candle's high is higher than the high of the candle to the left and higher than the high of the candle to the right. So clearly here, you can see that this is the highest high between these 3 candles. This is what we refer to as a 3-bar swing. You only need 3 candles to create a high. Now, there is a classification between short-term highs, intermediate-term highs, and long-term highs, but that's beyond the scope of this presentation anyway. I will get into that at a later date, but for now, I just want to keep things really simple. Whenever we see a 3-bar swing in the markets, let's assume that there's buy-side liquidity resting above those highs. Buy-side because it's above the highs. Now let's look at a sell-side example. This is where we're going to be looking at the lows. And again, same concept. The middle candle's low will be lower than the low of the candle to the left and lower than the low of the candle to the right. Again, clearly here, you can see that this is the lowest low between these 3 candles. Now, this pattern is very, very simple, but it is literally the building blocks to liquidity concepts and smart money concepts in general. Every reversal will be on the back of a 3-bar swing. But let's get into the charts here and let's break this down in a little bit more detail, right? Quick one. I've been working on something that I've never really done publicly before. On May the 18th, I'm running a 5-day live challenge called the High Probability Trading Challenge. Creative, I know. And I'm going to teach the exact process I use to look for any setup on any pair in any session and know it in under 5 minutes, whether it's worth my time or not. This is the same framework I've kept close to my chest for years and only ever really taught it inside of my private mentorship. On day 1, I'm showing you why 80% of the order blocks and fair value gaps on your chart right now were never going to work and how to spot the difference. And once you can see which ones were never real, day 2 gives you the 3 condition checklist I run before I ever risk a single dollar. From there, day 3 is where we take that checklist and I show you how I find the single highest probability trade of the session in under 30 minutes. Then day 4. I'm going to read the tape live, and you're going to see exactly how I apply everything in real time. In day 5, you're going to be building your own personal trading plan around your pairs, your session, and your schedule. Now, tickets are capped because we're running this live on Zoom, and Zoom does have a capacity limit, so it's a first come, first served basis. Early bird tickets are live right now. Click the link in the description, grab yours before we hit capacity. Right, let's get back to it. So here I've got a chart for gold. This is on the 4-hour time frame. Now, regardless of time frame of asset class, this is the exact same approach that you will take across any time frame on any market, right? Now, watch here carefully. Every single green arrow here represents a 3-bar swing high. And as you can see, there's a lot of them. Notice how this high is higher than the high to the left and higher than the high to the right. Same with this candle, same with this candle, same with this candle, same with this candle. Well, you get the drift, right? And above each of those candles, we're going to have liquidity. Now, same thing again for sell side. Every single one of these red arrows is a 3-bar swing low. Now, when you look at this chart first, it can look a little bit confusing, like, okay, well, which swing high and swing low do I need to focus on, right? That's a great question, because what we need to do here is we need to interpret the data in front of us. The first thing here, what we can clearly see, which isn't ambiguous, is we can see that this low, delineated with this blue arrow, is the lowest swing low inside of all of this segment of price action. And we can also see that this high, delineated again with the blue arrow, is of course the highest high inside of all of this segment of price action. Now watch closely. This swing low, or the lowest low inside of this range, has already traveled below all the lows to the left. So straight away, we can get rid of all of those down arrows because liquidity here has been engaged by price moving to and through all of those lows, right? Also, all of these swing lows here, price has already traveled to and through them and engaged all that sell side liquidity with this low down here. And this swing low down here has traveled to and through all these lows to the left. Notice that we have no lower lows printed below any of these remaining sell side liquidity pools, right? Now we can do the same thing for buy side. All of those buy stops or stop orders or liquidity pools have all been engaged and triggered with this price leg higher, right? This is the highest high left. Therefore, all the buy side liquidity has been purged. So we don't need to look at any of those highs now because this here is the highest high. To the right of the chart, we have these highs here still. Notice that this swing high is higher than all of these highs to the left. Same principle. We can ignore these highs in this context because we've already seen price travel to and through the highs to the left, and therefore the buy side liquidity resting above those highs has been engaged, right? So the highs that are yet to be engaged inside of this piece of price action is, of course, this high here, and ultimately the highest high inside of the whole range. Now, this gives us a little bit more clarity because once we understand what price has previously done, we can then start to anticipate what price is likely to do next. Essentially, by understanding what liquidity is left in the market, we can therefore predict the likelihood of where the next price expansion will occur. Now, what do I mean by that? So now that we can see where the remaining liquidity pools are, we can see that the highest high inside of the range is obviously this high, where we're going to have buy side liquidity above, and the lowest low inside of this range is down here, where we're going to have obviously sell side liquidity below. Now, because these are at the extremes of the range, the highest high here is going to have major buy side liquidity, and the lowest low is going to have major sell side liquidity. That's important because major sell side and major buy side is going to house much more liquidity than minor buy side or minor sell side like we have here. So inside of this range, we have shorter term highs. This is where our minor buy side is going to rest. And below all of these swing lows is where we're going to have minor sell side liquidity. Minor because it's inside of the range high and the range low where we have our major buy side and sell side liquidity pool. Now, we can also classify this into two different types of liquidity pools. Above the extremes of the range and below the extremes of the range, we can class this as external range liquidity because it's outside of the range, it's external to the range. All the minor buy side liquidity inside of that range, we can refer to as internal range liquidity. Now, price is programmed to move between internal range liquidity to external range liquidity, and then external range liquidity to internal range liquidity. Now, I want you to look at this chart for a second, and I want you to think about, where do we have more liquidity? Is it buy side or is it sell side? We can clearly see that we have so much more of a concentration of sell side liquidity below the market where price has yet to visit. And what happens? The market reprices lower back through all of that sell side liquidity. This is one of the ways we can interpret something known as a draw on liquidity. Where's the next likely price draw based on what the market has previously done? If we've already seen the market has cleared most of buy side liquidity and there's still a lot of sell side liquidity remaining in the market, then the next likely draw on liquidity is going to be sell side, and therefore our bias is going to be bearish. And within that context, within that framework, we can hunt for entries and setups. But let me just talk you through what actually happened here in price. So I'm going to zoom into this and just clear a little bit of the annotation so we can see here as a clean price chart. And I want you to focus on this area over here, right? Now, since price is fractal, we can clearly see here where we have, just in this piece of price action, the highest high and the lowest low. And therefore, we have our major buy side, external range liquidity, and our major sell side, external range liquidity. Notice above these highs here, we have minor buy side liquidity. This is internal range liquidity because it's internal between the external range high and the external range low. Now, note how close these highs are. This is significant, right? Because when we have highs in close proximity to each other, we refer to this as relative equal highs. And it means that there is a layering of buy side liquidity. And the more layering of buy side liquidity we can see, the stronger the draw on liquidity, because those relative equal highs are acting as a magnet for price to draw up into that liquidity pool. Now, of course, above those highs, if you're a little bit more experienced, you'll notice that we have an inefficiency here still remaining. And when we have both of these parameters in close proximity, especially around equilibrium or the midpoint of the entire range, this is an extremely strong draw on liquidity. But if that didn't make sense to you, I promise you, as you watch the videos in this series, it will start making a lot more sense. Now, look at the logic here, right? Price runs higher, engages with that internal buy side liquidity above these relative equal highs, and what's below the market? Relative equal lows. Again, same concept. There's going to be a pool of layered sell side liquidity below those lows, which becomes a very strong magnet for price. And again, what does price do? After engaging with that minor buy side, it reverses and then reprices lower to the major sell side or external range liquidity relative to this price range, right? Now, there's another little example here of where this is happening. I'm going to give you a second if you can see it. Right here. Now, retail look at this as a wedge, right? They look at, there's a trend line at the top, there's a trend line at the bottom, and prices contracting over here. What happens? Well, we have engineered buy side above this trend line, and we have engineered sell side below this trend line. What happens? Price runs higher first, engaging all of that buy side liquidity, and then it runs lower, engaging all of that engineered sell side liquidity. And then it holds into a consolidation, engineering more buy side liquidity above the highs, and engineering more sell side liquidity below the lows. This is what the algorithm is designed to do. Now, what's actually happening behind the scenes is it's not the algorithm collecting liquidity. It's smart money who understand how to interpret this algorithm and what it's actually doing, right? Because again, they need liquidity to move orders. So what's actually happening is below these lows, prices being accumulated. So smart money are going long using the sell side liquidity to pair long orders with. And then when the market runs higher, it offsets all of those accumulated longs to the willing buyers above the highs, because what's going to be above the highs? Stop orders, right? In the form of buy stops. This is what we can refer to as offset accumulation, right? But then watch what happens. Now, prices really travel through all of that liquidity pool, which was engineered above all of these highs. Smart money are selling here. They're pairing short positions with all of that buy side liquidity. And then where does price go? It goes back to all of these lows down here. What's going to be below those lows? Sell side liquidity in the form of retail sell stops, right? This is known as offset distribution. It's smart money distributing their shorts to the willing sellers below the market. Again here, price drops lower, raid sell side. This allows smart money to pair long positions with the retail sell stops and then offset those to the willing buyers above the market in the form of these relative equal highs. This is offset accumulation. And then what happens? Smart money again collect all of those orders in the form of buy stops, pairs their own short positions, and then the market distributes lower, allowing smart money to offload their sell orders back to the willing sellers below the market in the form of sell stops. And that is how the entire market works. It is the most important fundamental concept to understand if you are to be a trader. And this is why this is the first lesson outside of the introduction in this series that I really wanted to nail down, because when you really understand this, you never look at charts the same way, and you will absolutely understand that the market movement isn't random. It's absolutely engineered and programmed in a way where smart money are the ones capitalizing and you're the liquidity. But after this video, you won't be the liquidity anymore because you will understand the game. If you've found this helpful, please like the video, subscribe to the channel because it really helps me to continue to do this for free, and I hope to see you in the next video.